Everyone's celebrating Canada's GDP jumping to 2.6% this quarter, but here's what the headlines aren't telling you about what's actually happening in the housing market right now. So, Statistics Canada just dropped the Q3 numbers, and on the surface, it looks amazing. The economy grew 2.6% annualized, way better than the 0.5% economists predicted. Government bonds jumped, the loonie strengthened. Everyone's saying the Bank of Canada will hold rates in December. But here's the thing, when you actually dig into what drove that growth, the story completely changes. Residential investment surged 6.7%. That's huge. Housing resales are driving the economy right now. And with the Bank of Canada's rate sitting at 2.25%, that's still stimulative policy. They're keeping the housing market propped up. Plot twist, though, consumer spending dropped 0.4%. That's the first decline since 2021. Business investment fell for the second straight quarter. Final domestic demand basically flat at negative 0.1%. Here's what's really happening. The GDP growth looks strong because of two things: housing activity and government military spending. That's it. The actual economy underneath, weak. TD Economics put it perfectly. Strip out the noise from the trade war, and you've got a subdued domestic economy that's barely treading water. Now, here's why this matters if you're thinking about buying or selling. The Bank of Canada is holding rates steady in December. That's confirmed, but they're not holding because the economy is strong. They're holding because it's too fragile to mess with. And remember, during the whole inflation crisis, the Bank of Canada kept telling us rate changes take 12 to 18 months to fully work through the economy. Well, guess what? We're now seeing the delayed effects of those aggressive cuts they made earlier this year. The housing surge we're seeing right now, that's monetary policy from months ago finally kicking in. And October's flash estimate, GDP already dropped 0.3%. The momentum from Q3 is already gone. So, what does this mean for real estate? Short term, we've got a window of opportunity. Rates are staying low. Housing investment is still climbing, but the fundamentals underneath are shaky. Consumer confidence is fading. Unemployment is rising. Business pessimism is spreading. If you've been waiting for the perfect time to make a move, this is your signal. We're in this weird sweet spot where monetary policy is still supporting housing, but the broader economy is showing cracks. That window doesn't stay open forever. Ready to take advantage of this market before conditions shift? I'm offering free personalized consultations to the next 10 people who DM me the word strategy. Let's look at your specific situation and figure out your best move right now. Don't let this opportunity pass you by.